So the short-term interest rates are coming up quite a bit here, right? Let's see. Yep, all the way. So now, interesting. Now we're at 2.3%. Didn't think that their rate was above 2.3% already. I thought. I guess they're using this short-term yields UST 3 months. So I guess they're using U.S. Treasury bills. They're not even using Fed funds. That's interesting, eh? So if US, so there you are, 2.4%. Wow, look at that, eh? So that's the yield on the US 3-month Treasury bill. Oh, there you are. 3-month US Treasury yield. Hey, look at that. If anything interesting, do you see the potential divergence starting to form there, both on MACD and on this RSI study? That's interesting. So we're probably getting to the point where this rising interest rate move is getting long in the tooth. But wow, isn't that interesting? Now this is interesting. Glad I looked at this. So as you can see, Mr. Murphy here is flashing an inverted warning from the yield curve. That's fascinating. I wonder what the definition of what they're, because remember we had seen through all of this, there was guys in the public who were ranting about yield curve inversion, but this thing, through here, right? If we all go through this time period here, according to stockcharts.com, this thing never did go inverted. It was fascinating. And I got to say, looking at the slope of that curve there, really, that's fine. That's actually a pretty healthy curve. It's just fascinating. Then, of course, we have the sickness. And boom, there's your sickness. Boom, take rates down to zero. The whole economy just collapses, right? Even long-term interest rates. Like I said, I think that this is like a once in a lifetime image. You're just not going to see that. That was the Jupiter Saturn cross, if you will. And then, of course, as they basically took short-term interest rates to zero, again, normal curve, no recession, should be no worries here. But notice as time goes by and the economy perks up a bit, still interest rates at nothing here on the short end. No wonder we have all this goddamn inflation now. But as sort of like, oh my God, we've really the situation up here. You can see long-term interest rates cranking higher, spread between short and long getting pretty wide there. So the Fed, and interestingly enough, right, we talk about 3 steps in a stumble. So still sitting at almost nothing. Stock market's is basically at all-time highs, and then they start raising rates. Right? And what does the market do? You can see, and really holy steep curve, eh? But as they start raising rates, there they go. They're starting to come off zero, 3 steps in a stumble, that kind of talk. And you can see the stock market coming off. There's your stumble, quote unquote. So it is interesting to see how dramatically higher now short-term interest rates are. I mean, wow, what a move. I'm a little puzzled here at 2.3% though. This is still lower than obviously here. Maybe they're defining what takes this inverted based on what the 2-year is relative to the 10-year. That could be the case. You can see even here, 2s and 10s are relatively flat. So still flat, but then boom, you saw that tick up there. So something changes here. I'm getting the impression that there's some sort of threshold that causes this to flip. Now inverted, you saw that 2 spike there. And actually it's interesting when we look at those 2s, you can see that they're not really, I guess they rallied a little bit here, but they were really unhappy. They're breaking to new lows, even though the long bond is not. So you can sort of see Everybody tanking down. There's the beginning of June. Actually, I guess that's about a month ago, middle of June. Everybody's rallied smartly off of those lows, but relatively speaking, well, I don't think that's too bad. Actually, a bit surprised because and if anything, it almost looks like the rate of change of the 10s and the 2s is almost identical. So anyway, point of the matter here, everybody is rising of late, and then we had that extreme oversold reading in the bond market there about a month or so ago. Not a big surprise to see the market moving up. The energy markets all topped out there about 3 or 4 weeks ago. Looks like the energy market and the grain markets are kind of stabilizing. We got those the commodities now starting to firm up a bit. And so as a result, you can see that the bonds are actually sort of calming down here a bit. And the 2s are actually even making lower highs and lower lows, even though like the 30 is just going sideways here. So maybe that's what the market sees, right? Even the 10s are kind of just sideways, but the 2s are actually they're pretty well contained in a bearish, lower highs and lower lows defines a bear market. So that must be what's actually causing that yield curve to invert there. So that's fascinating. Now, if we actually get a message of inverted yield curve, what does that imply? Again, right, we're trying to think about edge here. How can I use this information to help me going forward? What does this imply? What's interesting about this is usually it's a message about what the world's going to look like 6 months from now. Recession. That's not a good sign. And you notice, right? We went inverted here. 2s higher than 10s. And you see what happened. And that's interesting that the curve inverted here, right? Back here, no inversion. Here, it inverted. Market was actually heading higher there into that inversion, and then we dumped. How about here? There's an inversion signal. Interesting how the market went flat, calmed down a little bit, but then boom, there we go back into inversion again. This is a dangerous situation, folks. I'm not going to sugarcoat it. This is a very, very dangerous situation.